I am hearing in the news that we are heading towards a recession. What is a recession and what does it mean to the stock market?
Okay, yeah, this is a really big deal. On a very technical terms, a recession is 2 quarters of gross domestic product negative, right? Two in a row. And but in a more generic sense, it just means the economy slows down to a point where it is no longer growing. It is actually shrinking in terms of our gross domestic product, right? So that's what we're looking at there. And the reason it's important to focus on is because it can have a pretty dramatic impact on the stock market. So we have all of these downturns. They happen, on a fairly regular basis. If there is a downturn and there is no recession that happens, with or right after that downturn, it only drops 15% on average. We're down 18% now, so we're kind of in that range. And the recovery time is quite quick. About 4 months is the average recovery time. If you look at, and this is since World War II on the S&P 500, if you look at, though, those downturns where there was a recession, either concurrently happening or happening shortly thereafter, then you end up with a scenario where the market's average drop is 36%, which is double from where we are now, right? And the recovery time is over 50 months on average. A much different scenario. And that's why when I see recessionary pieces come through, and it's not happened very often, but in 2008 it happened, 2000 it happened, right? And so when you get these situations, you probably need to get a little defensive. You need to, in my opinion, you need to hang in there on the market until you get some more definitive proof that you're going to have a recession. Because if you start getting defensive and there's no recession, the market could shoot right back up and you're going to lose some of that bounce, which can be incredibly important. So, that's why it's important to the stock market. It really just means, in very pure sense, that earnings will probably be falling from where they were. Companies make less money in recessions as a whole, and earnings are the ultimate driver of the stock market. So you've got, the scenario where the market's always looking forward, trying to guess when that next recession is, and basically, because of what can happen to the earnings, they're going to want to reduce the price of the stock to reflect the fact that the earnings might be coming down. And so that's the overall scenario there. It's not rocket science, but it is kind of interesting. What is rocket science is trying to figure out when the next recession is. It's not an easy thing at all. I really like using the leading economic indicators, LEI, basket of 10 indexes that is put out by the Conference Board. If you go back to 1960 and look at that chart, there's never been a scenario where the LEI hasn't been falling prior to a recession, or at least going sideways, like it was in 2020. And right now we're still going up. We'll get the new LEI number for April shortly, so we'll see what's happened in April, but we're still going up there. And so that's one of the things I'd really like to see, curling down before I start to think about the possibility of recession. We got a very hot economy. We've got a lot of reasons for the Federal Reserve to push down on that economy and try to slow it down. So the hope is that the economy is so hot they can still push on it and still have room for, what they call a soft landing, which is just, doesn't create a recession. But that's the big debate right now. Believe me, within the Wall Street community, everybody's debating recession, no recession, that kind of thing. And so it's an interesting question.